it going? My name is Joshua Stanton. I'm the mortgage dude. And today, my guest and I are going to be talking about the all-in-one loan. And if you've not seen one of our videos on this topic before, the all-in-one loan is a dynamic solution to the mortgage issue for millions of Americans. And today, I'm joined by the VP of All-in-One Finance, Mr. Dave Herbst. How's it going, sir?
It's going great, Joshua. It's good to be with you again.
Thank you. So we're going to dive right in. And Dave, I want to talk about money today. And I really want to talk about simple aspects of money that are greatly overlooked, in my opinion, or misunderstood in our society. I want to pick your brain about interest and inflation. But before we go down that rabbit hole, for those people who don't really know what the all-in-one loan is, can you kind of give us a brief overview in a nutshell?
The all-in-one loan is a privately secured mortgage product that we pioneered back in June of 2005. So it's important to note that it's not a new program to the U.S. market. It's been around for well over a decade, well established. It's different than a traditional mortgage in that it's designed to help people actually accelerate the pay down of their mortgage balance. And in doing so, help them save upwards of tens of thousands of dollars in mortgage interest costs. And also it provides them access to their home's equity dollars without having to refinance. It's different in purpose. It's different in structure. Really does go against the grain, the traditional lending and borrowing paradigm. And it's proven to help people pay down their balance at a pace of about 14% annually. So imagine eliminating your mortgage balance by 13 or 14%, per year, how that might change the trajectory of your financial situation. So it's a phenomenal product that offers just more flexibility and control of your payoff timing and the costs associated with borrowing money.
It's amazing. I mean, when you say 13% and stuff like that, I know this from experience. My clients, a lot of them are on pace to pay off their mortgage in less than 10 years. Some of them are like 8 years, 6 years, things of that nature. And it's totally doable with the product. So I'm going to go down this rabbit hole now. We're going to talk about smart money and really the paradigm shift that people need to make to understand the all-in-one. It's recasting interest versus fixed amortization schedules. Mm-hmm. And it's simple math when you get down to it. But, when people see a 2.875 30-year fixed interest rate or a 3% even interest rate, they think it's amazing. But why don't you tell us why that may not be so amazing?
The amortization is not your friends. It's really an enemy to you. And amortization is essentially a repayment schedule that determines in advance how much of your monthly payments go towards principal and how much go towards interest costs. The unfortunate truth is that they are designed to where most of your payments for much of the early portion of a loan term goes towards paying the lender's interest cost. And very little actually goes towards reducing your balance. So in effect, that's keeping your balance higher than necessary, which keeps your interest cost higher than necessary. And we're all sort of programmed, I think, to believe that this is the best way. It's really ultimately kind of the only way that we've been financing real estate over several decades, really since the Great Depression era. The reality is that these loans, although they're kind of the gold standard and they're really what everybody's used to, they ultimately have proven to delay our progress with really paying down our mortgage debt. And that's had an adverse effect in a variety of different areas, retirement security being one of those. If you are in debt for 30, 40, 50 years of your life, really your entire adult working life, homeowners are in mortgage debt. What other aspects of your financial world does that impede progress with, right? Mortgages consume an enormous amount of personal resources because of the amortization schedule. I always tell people the problem with mortgages isn't your interest rate. It's the amount of interest you pay, right? And the amount of interest you pay, again, is determined by that amortization schedule. So a low rate loan, or the benefit of a low rate with a mortgage, is really sort of muted because of how your money's applied to the instrument itself. And that's where this comes in. This is a complete, innovation or redefining of how money is applied to the debt. So that it actually reduces the expense and changes the payoff timing.
Expense, cost, paradigm shift. It's like you're explaining. It's the way that we have known mortgages for so long. But there's It's time for a change, and that's what we're talking about today, the all-in-one loan. I want to switch up a little bit, keep it on the money schedule, but inflation is out of control right now. It's extremely high. And at the same time, when you're talking about an amortization schedule, you're talking about perhaps a lost opportunity cost of your money when you're in an amortization schedule for 30 plus years if you refinance a bunch of times. Yeah. So, obviously inflation is a general rise in the price level of the economy over a period of time. And when the price level rises, each unit of currency buys fewer and fewer goods and services. So when you have the debt for longer periods of time, there's a lost opportunity cost with your money. But can you take that a little bit further and talk about, inflation and how the all-in-one loan can help individuals just get out of debt?
And so when we think about how your dollar is always at risk of losing buying power, which it is, right? And again, like you've indicated, and people are so aware of these days, inflationary pressures are spiking. And that's in part because of, supply chain disruptions as a result of COVID. And that's probably going to linger for many months to come, unfortunately, in certain areas, right? But the truth is, there's always been this omnipresence of inflation. The average price per square foot of real estate has gone up about over 70% in the last 20 years alone. The price of a four-door sedan has also gone up over 70% in the last 20 years. Our dollar is always losing value. It's estimated that last year alone, the US dollar lost upwards of about 20% of its value. And this is in part because of the printing of money and the inflation of the money supply that's out there. It tends to ignite spending, which pushes prices up, especially if there's supply chain disruption. Prices are going to continue to rise. And the unfortunate thing about inflation is rarely do we see prices come back down. Historically, you just don't see much. There might be some temporary relief in certain areas, again, because manufacturing or supply chains, get back up and running as we find ourselves coming out of this pandemic. But the reality is that once inflation kind of takes hold, you rarely see prices normalize to where they were, previously. But this is not a new topic. This has really existed for, forever. Historically speaking, the average annual rate of inflation is roughly about 2.1%. At least that's what our federal government tells us. Real inflation exists in a variety of different places within the market and the economy. And so you could look at things like housing, which inflates at significantly higher levels than 2%, right? In most areas across the United States, especially today. Yeah. And there's other areas too that are inflating at much higher levels. So let's just use 2% though. Let's use 2.06%, which is actually what the federal government reports as a historical inflationary value. When you think about it, what is inflation? And when we talk about it, and we say that your dollar is losing buying power. I think even then people don't really register what that means. And I don't mean to say that your audience isn't smart and savvy, but I think it's worth, trying to find different ways to talk about it so that it resonates, so that people can actually prepare themselves and implement strategies that offer them some savings, some shelter. Right. Think about if your money is losing buying power slowly and surely over time, you would hope that you also are increasing your income slowly and surely over time, at least at a pace that matches the loss of value of your dollar. Right. But that's not always attainable. It's not. Unfortunately, last year, a lot of people saw their income go away completely, right, due to the pandemic. So there's a lot of unforeseen challenges that come our way. It seems now about every 5 to 10 years. Meanwhile, the one constant is the fact that the dollar continues to reduce in value. Therefore, it buys less goods and services. As you take on mortgage debt or long-term debt specifically, how does that impact you? A good equivalent in considering what it means is really taking a nominal 2.06% or 2.1% inflationary rate annually and applying that to your mortgage debt. Like if you've borrowed money for the next 30 years, that's the contract. You've agreed to pay it back over 30 years of your life. What does that mean to the value of your dollar, right? Along the way, you may have secured and locked in a cost associated with that mortgage, like a fixed rate mortgage. However, your dollar cost or your dollar value is not fixed. It's going to continue to deplete. So as it does that, that means you need to actually put more effort forth, right, to earn the money that it's going to take to sustain your lifestyle. right? As the value of the dollar reduces and you owe all this debt over 3 decades of your life, it's going to get harder and harder and harder to maintain a level of lifestyle that you're used to. You've got to work harder for those dollars, right, to afford it, because everything around you is going to get more and more and more expensive. Conversely, I think that your point here, Joshua, is that the faster you get out of debt, the faster you eliminate it from your life, the better off you'll be. The more money you'll have in your hands, right? And the higher optionality you'll have in order to protect that cash, maybe invest it, grow wealth, turn it from a liability, because assets that reduce in value technically are a liability. And that's what cash is. Even if sitting in your checking account for a day or a week or a month, it's losing value. It's a liability to you. In the best of worlds, you want to convert that as quickly as you possibly can into something that's going to shelter it from inflation and maybe even either grow in value or also maybe at the same time reduce an expense to you. And that's exactly what the all-in-one loan does. It's a shelter from inflation while it also reduces mortgage interest expense.
You hit the nail on the head when I was thinking of my next point. I wanted to kind of, talk with you about, and it was the big point. And you just explained what the big point is. By using all-in-one loan, you now become the bank. You keep your money liquid and decide how much interest you're going to be paying according to your ability to pay down, and not the bank's amortization schedule. So now you have the power to control your money. The tool keeps you organized. It simplifies your life. It's just how the whole thing works.
Instead of signing up to a lengthy, repayment schedule that the lender or bank plans out for you in advance, that may feel comfortable and affordable. You may have a lower interest rate than you did previously, or that your neighbor does. All those things, we've kind of are programmed to feel good about. And financially, there's some savings that are picked up, of course, by reducing your interest rate, potentially. The very tools that we use tend to prolong or delay pay down. And the longer you're in debt, the more exposed you are, and the more it's going to cost you. If you can reduce your monthly costs and also reduce your total costs and also protect your cash while it's on hand so it's not losing value, then you're getting everything you possibly could need and want. And that's exactly what the all-in-one loan was designed to do, was really, as you stated, you really create this paradigm to where you get to operate as the banks do. You become the bank of you, and you get to use and leverage your money and benefit from it more so than anybody else.
We've had multiple conversations about financial advisors. I know you work with a ton of them for this particular product, and I do as well. They're some of my best referral partners. But can you talk a little bit about what they tell you, and if they have somewhat of a different perspective or additional view on the all-in-one and how it can affect obviously your retirement with inflation and just paying off everything?
Well, I think one of the things that tends to hit a nerve and create sort of an awakening amongst the advisor community and fiduciaries, holistic planners specifically, who tend to look at both sides of the personal balance sheet, not just the asset growth side of the household balance sheet, but also the liability side. So holistic planners that look at both and really try to implement strategies to cut back on unnecessary expense, to help improve the asset and the protection side of somebody's balance sheet and all their needs. That's who tends to gravitate towards this loan and really get it. But there's still an awakening that occurs, right, as part of the process and journey for them as they learn about this loan. And one of those kinds of shifts in thinking is related to regular personal banking. As we've exposed in other videos, the all-in-one loan is part mortgage and part checking account. It's these two components that we use every single day to manage our income with and pay our bills from, as well as that we use to pay down our mortgage debt with, right? So the all-in-one loan combines these two together, and it creates this very beneficial and powerful relationship between your idle cash and your mortgage debt, right? And automatically, in an effort to reduce how much you owe, therefore reduce how much you're being charged in interest, right? So it reduces your exposure. Meanwhile, it keeps your cash liquid, right? So unlike any other mortgage product out there, it's truly the only 100% principal paid first mortgage product in America. It's also the only mortgage product in America that computes interest nightly based on your unpaid principal balance that you control through your deposit withdrawal activity with the linked checking account that comes with it. the advisors generally kind of awaken to this idea that the checking account is a powerful mechanism. I don't think they generally think of their client's checking account as really being a useful tool.
Yeah.
And think about it. The money that transfers and flows through a personal checking account, that's already sort of spoken for. That's not cash that's being invested in the market. It's got to remain liquid. You can't go put it in equities. So that's really sort of money that they can't touch and put to work. Now that's unfortunate in the standard traditional paradigm, because money in a checking account or savings account, money market account, any cash account is earning less interest than mortgage debt is costing their clients, right? So like the old adage goes, wealth or money doesn't disappear, much like wealth, it transfers, right? And your money is either transferring towards some other entity, somebody else, or it's transferring to you and benefiting you primarily. In the standard world or paradigm, we keep cash segregated in a checking account, earning very little or no interest at all. But think about the volume of money, Joshua, that goes through a regular checking account for any one of your clients.
Yeah.
Most people will actually flow more money through their checking account in just the course of 5 years than they owe on their home, right? So the reason why it takes 30, 40, 50, 60 years to pay off a mortgage is because your cash is segregated, kept separate from the mortgage. We're bundling that together with the all-in-one loan. And this is where the advisor really, their curiosity really kind of peaks, because they tend to start looking at that cash as an asset, right? Yeah. As a way to leverage it automatically, if even temporarily, if even for a day. You make a deposit today, your mortgage balance drops by an equal amount today. You're in effect now saving mortgage interest on that lower balance equal to the loan's interest rate, which is much better than you could have gained in a traditional checking account. For financial advisors, I really home in on that activity of personal banking. It's a powerful tool. And unfortunately, in the standard or traditional world, those dollars go underutilized. They're underappreciated. In the all-in-one world, they are put to work. So that money goes to work immediately upon deposit to help their client save and avoid interest costs. All the meanwhile keeping that cash liquid. So advisors that kind of really gravitate towards this loan, look at this as a way to shrink the amount of interest you have to pay on the loan, on your mortgage. Therefore, you're really ultimately able to retain more and more of your own income, the money you've already earned. Surely there's better places, more important places, more impactful places to spend those dollars than on mortgage interest, right? Yeah. Ultimately, this loan creates an opportunity for clients to invest much more aggressively sooner in their life, because the mortgage debt is eliminated faster.
Awesome. Well, thank you so much, Dave, for talking with me once again about this powerful product, the all-in-one loan. And for listeners that have any questions about the all-in-one loan, or if you want to see a personalized simulation showing how this loan could possibly change your life, you can get in touch with me directly at JSTANTON. That's J Stanton at cmgfi.com. I'd be happy to show you. Until next time, thank you so much, Dave, and we'll talk to you guys soon.
Thanks, Joshua.